So you want to learn how to make money without getting a lot of stress. You want the lazy trader's way to make money, put money in the bank, and multiply your money faster than having the stocks itself. Well, this is the video for you, and what I'm explaining is the quad 4 trading strategy. So let's get into it. What is the quad 4 trading strategy? The first thing you need to understand is something called quad witching or quadruple witching. No, this isn't about magic and dark spells and theories or anything mysterious like that. Quad witching, actually, if we Google it, is actually a phenomenon that refers to the simultaneous expiration of four types of derivative contracts at the same time. So stock index futures, stock options, stock index options, and single stock futures. All four of these things expire and rebalance at the same time. And it only happens 4 times a year. So as a kid, if you ever heard of the situation where they say, oh, this asteroid, you only see it once every 100 years. There's something like that in the stock market, but it happens every. So for 2025, you can see the dates: March 21st, 2025, June 20th, 2025, September 19th, 2025, and December 19th, 2025. And what usually happens due to the rebalancing of these options is that options prices actually become cheaper. And then on top of that, usually around then, the market dumps. So for example, this year, it was on March 21st, 2025. In April, the market dumped for like 4 weeks straight. We lost about 17% of the total market value in literally 3 or 4 weeks. That's typical around quad witching, and September 19th is coming up. So we're literally about to run into this time again. So what is actually the strategy? The strategy is whenever quad witching happens, or whenever there's a major dip in the market, you go and buy skips or leaps. So what are skips or leaps? Well, you should know what a stock is. Okay, so let's say we're looking at a stock like Apple. If you want to go and buy Apple stock, you just type in Apple stock in whatever brokerage you use, whether that's Robinhood or whether that's Fidelity. You pay whatever price it is for Apple stock. But in this situation, we're using the options. Why? Because options give you leverage. So for example, if the Apple stock goes up 10%, you only made 10% on your money. If the Apple stock goes up 10% and you have the correct options contract, you would make literally 50% to 100% on your money on the exact same move. This isn't just theory. I did a move like this literally 2 weeks ago where I bought an Apple contract and I held it over the weekend, and it went from $217 all the way to $775 per contract. So it literally tripled in the span of 3 days. That is the power of options trading. But we want to be a little bit more safe with it. So we do that by buying out self-time. So instead of buying weekly options contract or monthly options contract, we're buying leaps and skips. A skip is something 4 months out or further. If you're buying an options contract 4 months out or further, that is what's called a skip. It's what's called something a year. That's called. So with options, what you want to do whenever you have these quad witching, once every quarter, you load up on skips and leaps. An options contract lets you go as far as 2 years out. Remember, the reason we're doing options contract is because we're getting this on the same move. We're making 4, 5, 10, sometimes 15 times on the same move of the stock. And of course, we're buying it on discount. It's like the ultimate money sale. You're buying very good stocks at a huge discount. So how do we actually do this? So what does the strategy actually entail? Well, it's very simple. One of those 4 times of the year, around March, okay, then June, then September, then December, whenever the market dips, and you'll see it, whenever the market dips, you go and buy these leaps and skips. It's a very simple strategy. You only do these trades, like I said, once a quarter, and that's what you do. So how do you actually know what options contract to buy? Very good question. Because the market goes up 70% of the time, we only want to focus on calls. Puts us a whole nother strategy. I don't want to get into this on this video, but this is the lazy way to make money through options. So that's what we're going to focus on. We're buying calls. And a call simply means as the market goes up, we make money. So if you go to any options chain, and I'll put up a Fidelity account here, there's 2 things I want you to pay attention to. The strike price, okay, and the date above, and that's a Fidelity. So if today is August and this week ends in August 29th, a skip will be at least 4 months out. So 4 months out for August will be January. So I will start going into January 2026. And you see it marks it right there, January 2026. You can do this on Fidelity. You can do this on Charles Schwab. Literally any brokerage that allows you to buy options, you can do this with. And there's two things you want to pay attention to here, because people say, okay, now that I have the date, how do I make money? How do I know which contracts to pick? Am I look confusing or not confused, whatever that means? Remember, we're buying calls because we want to bet on the market to go up. Puts bets on the market to go down. Now, I'm not a financial advisor, and this is a financial advice, and obviously check with tax professionals, and everything involves risk. But this is something I've done for years and something that I've made profit on, and me and over 3,500 students have used this exact same method because it is very safe, because you're buying things a year out, 6 months out, 2 years out. So even if there's any downturn, you have enough time to ride out that wave and make multiples on your money. Does that make sense? So what I do in this situation is very simple. I look at two things: the volume and the open interest. This is how you pick your contracts. So let's say I want to buy for August 21, 2026 on Apple, because I think Apple is going to go up. I want to buy something called out of the money contracts. I just tell them to show me all the strikes. I see all the strikes here, and I look for volume and open interest. Volume is the amount of people that bought the contract today. Open interest is the amount of people who bought the contract and hold it in general. So for example, 20,000 people hold this in general, and 41,000 people bought this LEAP contract on Friday before the market closed. So in total, there's about 61,000 people, 61,000 contracts at this particular price. One thing you need to realize is that 61,000 contracts doesn't mean $61,000. To get the real idea of how much money is in this contract, you have to multiply the 61,000 contracts times the $230 strike price. So that's literally about, I'll do the math real quick, $61,000 times 230, that's $14 million in here. This is what I mean by following big money. You don't have to be a genius to know which contract to pick. This one has literally like a fourth of the amount of people, amount of contracts. So which one would you rather put your money in? The one where big money's putting 14 million in, or the one where big money's only putting 2 million in? But let's go to the January 16th one. So for January 16th, for example, this is considered a skip. And you want to see which has the most amount of people for the least amount of buck, the most bang for your buck. So for example, in this contract for January 16th, 2026, it's a skip, it's not even a leap. You can see that this has about 24,000 people in it in total. Oh, because open interest is the people who own it in total, and volume is the people who bought it today. So if you add them together, that's about 25,000 contracts in here times $230. That means that's about 5 million in this contract. But that's going to cost you $1,445. A little pricey maybe, but you want to see. But if you go down the line and you compare where the big money is, look at this. All the big money is hanging out here. There's 49,000 contracts hanging out here, and it's a fifth of the price. It's only $585. You $5. Right now, Apple is $227. So you're telling me in 5 months, Apple cannot get to $250? If Apple gets to $250, this $585 conservatively is going to get to $1,800. You're literally almost going to 4x your money, something safe, 4 months out that has big money in it, that has literally almost 50,000 contracts in it. And if I do the math, so 49,000 plus 1,900, let's just call that 51,000 times $250. That means there's 12.75 million people. So if I had to buy one contract, it's because everything in options is 100. An options contract controls 100 shares. So $5.85 is per share. Since it's 100 shares in one contract, that means that you're paying $585 for this contract. But paying $585 controls a versus paying $227 to own one share. So you see how you're going to multiply your money and you're having max leverage with options. This is a lazy way to do it, guys. So every quad witching, as the market dips, just come in and go to your favorite stocks and then go ahead and buy the skips or the leaps. Okay, skips are about 6 months out, leaps are about a year out. The way I determine which one I buy is by how much I love the company. If I really like the company, I love it a lot, or it's like the big four, like the Apple, the Meta, the Tesla, stuff like that, I will go ahead and buy a skip and a leap. So you can buy multiple. If it's something that I just want to do short term for multiplication, multiply my money, I'll just buy a skip. Okay? But if it's something that I really want to hold in my portfolio a long time and I think the stock itself can 5x, 10x, 20x, a leap will be something you want to buy. An example of this for me is SoFi. So again, not financial advice. Another one of this, I own some leaps and skips in XYZ, which is blockchain, which is Square, the company that owns Cash App. Again, not financial advice, not recommending any stocks, but just telling you examples of companies I do this on. And literally you can just steal the work of the big financial advisors. How do you do this? You just go to Google and you type S&P 500 by weight. And S&P 500 by weight gives you the top 500 profitable companies in the United States and tells you how much of it is being held in the S&P 500. So it lists the company here and the symbol. So if you ever feel like I don't know which companies to do this on, just pick one of the top 20. Any of the top 20 will do, okay? And it's literally a cheat code. Why? Because trillions of dollars are in this company. The United States economy, when they say, oh, the market is going up or down, a lot of times this is what they mean. This is exactly what they mean. So I'll just go to the top 20 companies and I'll just buy skips on leaps on as many of them as I want. This is a no-brainer way to make money and multiply your money. So let's summarize this step by step exactly what the quad witching strategy is, or what they call what I call the quad four. Number one, you want to look around the time these options contracts actually rebalance, what's called quadruple witching. If you Google quadruple witching in the year, it will give you the exact dates. That's step number one. So you want to know the quad witch period. I don't know why it's called that. They just call it that. Now, around this time, especially if the stock market has dipped, then what you want to do is go and then buy leaps and skips on your favorite options contracts to trade. Once you know the stock you're going to use, and depending on your capital, I will spread it out over 2 or 3 different stocks. So for example, if I saw Apple, Amazon, Nvidia, and Facebook as the top 4, I would spread my money evenly over that 4 just to diversify it. And then I would then go and start buying skips and leaps. If you can, do the leaps because they're longer term. The more time you have, the less headache or stress you have to worry about. Is literally set it and forget it. Number 3, once you've identified the stock or stocks you're going to do this on, you go and purchase the skips and the leaps by looking at the open interest and volume. So I'm going to call it the open I for open interest and volume. The one with the most open interest and volume for the cheapest amount of price. Obviously, the further down you go, you can get stuff for like $1. But if the open interest and volume on it is not good, you don't want to do it. Number 2, you want to pay as much as you can to be as close to the money as possible. So for example, if you saw one that has 50,000 people in it, and it's at the 230 strike, and Apple is 227, but this costs you $1K. And you see one that's all the way down to the 200, it has 30,000 people in it, it's fine, and it costs you $650. But you see one at the 250 that costs you $800, and it has 40,000 people in it. This is the best one to choose. You want to pick the one that's closest to the money, that's a fair price because it's a very good company, but gives you the best bang for your buck. Another rule I give my students is that you want to buy more than one. You want to buy 2. The reason you want to buy 2 is that at a certain point, your contracts are going to be over 100%. That means that you're going to double your money. And there's a very key point. So for example, if I bought 2 contracts and my money is now double, I can sell one and let the other one rest. So let's say I put 1K into this trade and I have 2 contracts. I bought them for $500 each. And that 1K now turns to 2,100. I can sell 1,100, put $1,100 in my pocket, and then the other 1,000 I could just let ride free. The reason you want to do that is I've seen that last contract go from 1,000 to 15 grand by itself. Matter of fact, the trade that I did when I bought Amazon for 300, and 6 weeks later it turned to $30,000. This is exactly what I did. I let it ride. So you want to give yourself the ability to do that. So again, the contract that allows you the best bang for your buck, that allows you to purchase more than one contract, is usually best. Number 3, sit back and let your money work. Don't stress. Let your money make money for you, and then take profits as time goes on, and then rinse and repeat the process every quad witching. And what you do is build an asset for yourself of options contract that are long term. And as stocks go up, like stocks usually do, you become richer and richer and richer without stress. It's literally the lazy trader's way to make money. I have a full course on all things option swinging. So instead of making money over a longer term, if you want to start making money every week or every 2 weeks or even every day, I have a whole nother comment below. DM me, but this is the quad. That being said, let's get to cash flow and let's start